Good evening, ladies and gentlemen. This is Clueless Trading Frank. This is a quick, short, to the point market forecast, which are very, very critical for your effective trade management on any type of trades that you're doing in the upcoming week. We have a shortened week coming up with Independence Day, July 4th holiday. So Tuesday is a holiday, and tomorrow is a half day. Markets close approximately around 1 p.m. I keep on forgetting that all the time. But so it's going to be a shortened week. So let me get straight to the point here, and I just want to focus on a couple of very simple technicals, which I think should help guide active and traders as well as swing traders in determining how they should manage their trades. Always remember, trading and investing, specifically trading because we're dealing with shorter time frames, is a game of probabilities and not a game of certainty. In very simple terms, if your risk reward is skewed towards the upside or downside, depending on which bias you have, long calls or long puts, long or short on the common, and if your risk reward is skewed based on your determination on either side, then obviously you want to go ahead and take that trade and make money. Just a quick reminder, despite the intense volatility in the markets, Clueless Trading has managed to deliver some significant profits both on an intraday and swing basis. I won't even get into the symbols and the trades that we have done. All are posted on the real-time Twitter feed, and for active traders, they know very well what we do on a daily basis, regardless of whether the market is up 300 points or down 300 points. And that is the essence of technical and what I call tactical charting. A very important fact of life that many in our group, and certainly a majority outside our group, have failed to accept. Because human emotions generally are always in a state of denial, and humans in general want things easy. So when you want it too easy, it just doesn't work. So the fact that I want to mention, which is the reality of what we deal with on a daily basis, is this market go now for the past couple of years, more so in the past year or two, and going forward forever, is going to be a very machine-driven, algorithmic, high-frequency trading, black box dominated market. What does that mean in simple English? It simply means you are trading against the machines. My charts, which I strive every single day, every single hour, every single minute to deliver, try to game from a technical standpoint what the machines are going to do, both on the upside and the downside, so that traders can effectively manage their trades and not be befuddled with surprise and shock and awe when the markets ramp up 150 points or ramp down 150 points within a matter of 60 minutes. So this state of denial that most retail human traders are in has to be decimated. You have to force yourself to accept the new paradigm, what they call in the business the new normal. And the new normal is that if you're not trading, whether it's intermediate term, short term, or longer term, on a technical basis, then you are not going to survive these markets. We have fallouts in our group, lots of people coming in, some people leaving. I believe that the ones who leave are the ones who are in complete denial. And I'm not just saying that as a marketing pitch, it is a fact. I deal with it in my own portfolio every single day. And all of you who are trading actively or non-actively, inactively, whatever the case may be, or just watching from the sidelines, see it happen every single day. What surprises me many times, and I say that in the clearest terms, you know I'm a straight shooter when it comes to it, whether you like it or not, is the surprise element that seems to emanate from many members when dramatic heavy volatility moves occur within a very tight within a very structured price range that I constantly keep on showing. Those are fluid price ranges. That means they can change as the days go by, as the weeks go by, but I show them pre-market, during the day on a real-time basis, which is one of the key features of my service, and bar none, one of the finest real-time posts on trade alerts and real-time charts that any service can offer, all for the benefit of our members and traders. So it surprises me quite a bit that even after all this time, there is a state of denial with many human traders as to the volatility that is manifested within the markets on a daily basis, regardless of the fact that my charts are clearly showing the ranges that the market will trade in. So what your job is to mentally calibrate, what I call mental calibration, a change of your behavioral look at the way you trade in order to maximize your profits, which many tactical traders in our group do on a consistent basis. Not to mention we don't take some hits, but our gains are far, far higher, for a better choice of words, on a percentage basis. We are delivering anywhere from 60, 80, 200, 400, in some cases 600%. One of the highlights, Bank of America. 6 cents, 8 cents, 10 cents goes to 90 cents. Do the math. That's a 7 to 800% gain on lottos, on simple, cheap options. Because remember, when the game of numbers, it's the percentage that counts, not the actual price. So 6 cents is the same thing. If you think about it, if you move the decimal forward, it's $6. So a $6 call, if it goes to 90, it seems amazing. A 6-cent call going to 90 cents might not seem that much because our brains are geared towards larger numbers. So if I say to somebody, hey, you bought a $6 call, it went to 90 bucks, it's just like, oh my God, that's unbelievable. It's too much. Well, it's the same thing as a 6-cent call on an option call going to 90 cents or 60 cents or 70 cents within a matter of 24 hours, if not 48 hours. So the other key thing that I want to mention to people very clearly is we're not talking about these gains over a period of option trades, period of months and weeks. We're talking about things that are happening due to the volatility that is incurred in the market, the wide swings within a structured range that are happening within 24 to 72 hours. And on swing trades, a couple of days, maybe a week to 10 days. So you have to appreciate these things. Sit back and think for a minute. We're delivering trades which are generating triple digits on a percentage basis. What are you doing with your money? It's not I can control. I'm just suggesting the trades and delivering the numbers. On that note, let's dive in. So here we have a chart, and I want to keep this real simple. This is the chart for this week. Period. It's saved on my system on investing.com, and the lines are clear. Here is fan lines on the downtrend side. This is the actual futures trading right now. Futures are up roughly a little shy of 6 points, and this is where we are. Here's your structured range on the E-minis, which you have to add roughly 5 points or so to arrive at the actual S&P 500 that I've told my members on my ACS advanced coaching sessions, as well as the regular video cast. So 2428, let's say, is roughly translates into 2433 on the S&P 500. Why do I use the E-minis? Because they're dynamic. They're moving as I'm doing this video cast. Okay? And this is the Globex market in action. Futures are up 550 right now. They were up 5.75 a couple of seconds ago. So the E-minis and tracking the SPYs, but primarily the futures market, allows you to manage your trades so you don't get caught in a downdraft that might suddenly appear just like that. And when it does appear, you have to take action and not panic, because if you panic and the lower end of the range, which I've been talking about for weeks now or so, if not days, is in this 2417 level. I'm not even going back here. I'm not going back past the big flash crash that occurred just last Thursday on the 29th. Seems like this is a chart for years. No, this is a chart from last Thursday. Big flash crash that started on the futures approximately right before the market, and then started to come down and complete all stops triggered, big time selling in the tech side. I believe a couple of hedge funds basically blew up literally, because when you have these type of drops, which normally would take weeks, happen within a matter of 1, 2, 3 hours, culminating into a large reversal, which we caught at around 1:15 p.m. You can play both sides. Or you can sit back and look for those reversal alerts that I give, the hammer reversals and things of that sort, or in this case, a hammer reversal followed by a bullish engulfing candle, multi-candle expansion, and then moving into a trading range for the rest of the day and the following day, and then falling into this trading range. So let's get back to this. I'm going to keep this simple without getting complicated. This is the trading range, 2429, roughly about 2434 on the actual S&P 500. And on the lower end, 2417, let's call it 2418 for analysis sake, 2418 or 2419, that comes to roughly 2424. Write these down. 2424 on your S&P 500 converted. The conversion is roughly 5 points higher than what the E-minis are on a cash settlement basis, approximately. So just look at things visually. There's your range. So if you drop, if the market opens up and we suddenly drop from here straight down to 2418, nothing really changes. So you don't need to get all excited and bent out of shape that the markets are approaching this green line here, the upper end of the range, because algos are going to hit it just the way they did here at around 3:45 on the 30th, 15 minutes before the market closed on Friday. Boom, big sell program. Big frigging deal. Where are we now? We just got back almost everything. So if you're going with this sell candle, which is a function of the last day of the second quarter of 2017, massive portfolio adjustments. The gain was made from this move higher, which we participated in tremendously, as I alerted. And now in a sideways band moving between 2428 and 2416. So that's roughly about 13 or 12 points, translates into about 70 Dow points. That's 70 Dow points between these ranges, just for people who want to keep it simple and think about the Dow Jones Industrial Average. The range is 70 Dow points. not the end of the world. 70 Dow points can affect individual stocks by a larger percentage, obviously. But if you're going with this, and if the market opened up here, and we bought moderate long calls going into Monday and going into Wednesday, because Tuesday's a holiday, July 4th, you win. If the market's opened up right now, up 6 S&P points, you just made 50 or 60% on those S&P calls, because there is very little time value left because they're expiring on Monday at 4 p.m. You're dealing with just intrinsic value, which is just the value of the option, not time value. So you sell right at the open. You open up 6 points, you're up 50 or 60%, or even 40%. You just got 40% for buying it down at these points and not panicking. That's tactical trading. Gotta understand the ranges, the structure of the patterns, and I do a heck of a job trying to show all these things on a continuous basis all day long. So let's move on. So here's your range, 70 Dow points. Either it's going to break out, then we have these uptrend lines here. We're going to head towards 2440. That's going to be a sweet move if you're long calls on this breakout. Or that breakout is going to hit a roadblock right here. That's why I draw these charts. Make this a little bit thicker. Right here at around 2432. So that's from this point on a real-time basis, that's about 6 points. Translates into about 30 Dow points. Makes a big difference to individual stocks that you're trading on the high momentum side. You go out 30, 40, 50, 60 points in the Dow, then the high momentum stocks like the Amazon, the Googles, the Netflixes, the Apples will go up nicely. Those options will be up. Could be a double. A point and a 2 move on Apple can give you almost a double on those cheap options. I did alert Apple on Friday and in previous day, depending on the lot. We're not looking at the chart right now. So that's how you got to look at it. You can't. A lot of traders who come into this business always think in very large terms. Oh, the market has to be up 300 points for me to make money. Market's up 300 points, and the way we do it, you're gonna make how much? You're gonna make 400 to 600 points. I mean, anywhere from 300 to 400 points percentage on the ROI on the short-term calls, because you're playing with the momentum, and vice versa on the downside. So don't look for this perfect nirvana type of scenarios where the market has to do this in order for you to make money. You can just make money of these structured ranges. That's what smart traders do, and pay a lot of bills. I can only suggest, I can teach as much as I can. It's up to you how you change your mental mental structure, mental calibration, as I call it, and make money in any type of market that's in front of you. You don't need to have a massive breakout. You don't need to have a massive breakdown. You can trade the ranges. Listen carefully to what I say, because this is what I go through every single day, and I have quite a few years of experience to prove it. Stop going with the same old style that you're doing, and it's not really working. Yeah, you're catching a few things here and there. Saying all that, chart is drawn. Upper end of the scale is here. That's the most you're going to get if you get a big burst up on the market on Monday, or you're going to come down to the lower end of the scale. If it breaks this, we got different levels to contend with. You can you got the pivotal low at around the 2400 level on the E-minis, right? 2400 level on the E-minis, and 2400 is a key level, guys. Is a key level, both psychologically on the S&P 500 and the E-minis. So write that down somewhere. You break 2400, we're going a bit lower. Not the end of the world, not falling the abyss, but we're going lower. And psychologically, it's not going to be good because you lost 2400. It's going to be all over the media. Technician is going to come out, oh, we lost 2400. Whoopee. And I'm not going to go through those charts right now. I'll show them as I post my charts during the day and pre-market with all the markers. So here's your level. So this one. So I'm going to make this a very, very thick line. There you go. Do not cross the red line. Upper end of this band is up here, which is the highs on the S&P, well, close to it, which is approximately 2450. So the wide band is 2450. Obviously, this shouldn't be red. This should be a fat green. And that's what we're doing. In the meantime, this is what we're doing this week. Trading this range, looking for a breakout. And just because it's a breakout doesn't mean it's going to go all the way up here. It can, but it doesn't do it in a straight line. You and me know that, right? We all know that by now. And the people who are traders who are in denial, you guys know that too. Denial or not. Accept and embrace volatility. Look at the charts. I'm trying to keep this real simple. Every single line here matters. Every single line here is an inflection point. When we were crashing on Thursday and catching bits and pieces of this S&P puts and doing really well, keep in mind that there were points of reversals, clusters where they tried to reverse, failed. Now, the reason why this happens is I was explaining to one of my favorite members on a private ACS advanced coaching session this weekend, was that this is where they try to, these are the points where the clusters or the shorts cover. And then there must have been a very large sell program triggered on the algo HFT side, which was mentioned by the gurus on CNBC or so, okay, that caused multiple fallouts. And I love the fact that we tested the 2400 level. We needed to test the 2400 level. Look at my past video cast. It happened very quickly. It happened in 1 hour. From 2444 down to 2400 is roughly 250 Dow points from top to bottom. Love it. The faster it happens, the better off the reflex bounce will be, because the underlying fundamentals of the market driving the markets higher are intact. Synchronized global growth. Look at the two reports I put out there. China and Japan, both manufacturing index very strong. Anyway, so here's your structured range, 70 Dow points. If we break down, it's a good chance we're going to test the 2400. It's a fantastic shorting opportunity. And you know me, I'm not going to be sitting there. I'm going to be learning very quickly. Multiple trend line, downtrend lines here, fan lines. No biggie. These are very tight ranges. Breaks out. This is the upper end. And who knows? We might even test this. Given the ferocity of this sell-off, this pattern here will be repeated. However, it looks more likely that it will be reported off a double test bottom at 2400. Will that 2400 be tested this week? In other words, will we fall another 100 to 150 points from here to here? I would love it. Keep cash on the side. Because once it gets here, it's going to be another heck of a bounce. Or we stay within this band, go here, fail, come down, test the upper end of this band, try to bounce back and take this high. So it's not mandatory that we test the 2400. It would be nice, just so you know, because then we have a real opportunity to put in aggressively some decent money and trade the bounce up for another 100, 150 points, trying to re-enter this very, very critical trading range that the market's been trading in for the past couple of days. That's the end of the story for this chart. I'm not going to elaborate anymore. Let's move on. Now we're going to take a quick look at the E-minis, the finest trading tool ever devised by man. This is your daily chart. It's holding the 34. It's holding the 50. And it still wants to go higher towards 2443, 2450. I don't know how much time I have left on this video. Looks like if it shuts down at 25 minutes, um, that's where I'm going to keep this. So things are all, well, it's gone over 25 minutes. It's been still recording. Great. So I don't have to cut it off because I would, explaining all this stuff to you. So looking at this chart here, a couple of very pivotal points. This magenta line is your pivotal breakout. Pivotal breakout. Critical. Okay? Again, at 2400. This is the actual E-minis here, right? 2400. Right there. That's why it's a breakout. I wrote pivotal breakout level. Can't get any simpler than that. That brings me to one of my biggest complaints with some members. Read my simple English. If you do not understand my English, that is the way I'm writing it, okay, then use Google Translate to translate to your language or whatever language you want to speak. Because honestly, I make it as simple as possible. And if you cannot understand the stuff that I'm putting through straightforward, very, very actionable, money makers, then you have a problem understanding basic terminology. And I can help you with that. I hope everyone hears that loud and clear. My Twitter posts are very clear, to the point. Parameters of the trade, support levels, all kinds of stuff. So you know what you're heading into, whether you're going to fall into a ditch or you're going to, even if you fall into a ditch, how you're going to dig out of it. Volatility cannot be measured every 5-15 minutes. And nowadays, markets are so frigging volatile that I can, it's tough. You got to adapt. But I show you what the ranges are and where we can hit. So we had a big fat hammer reversal off the 50. This is the daily chart off the 50 moving average on the futures, which is far more reliable than just looking at the overall index, especially for traders. Fat hammer reversal, stayed above the 34 on the 30th. Right now we are here on the 3rd. Well, going into the 3rd or the 2nd, right? And it's going to try to go over this blue line here, which is the 20-day moving average, only 5 points higher. So futures could be up 10 points for all you know at the open. Is it time to get super excited? No. If you're long the SPX calls, which I suggested, you want to sell most of them right at the open, and especially if they're expiring the same day, because you'd have booked yourself close to a double if the futures were up 10 points at the 20-day moving average. And if you had bought the lows on Friday, which I had suggested, at 24.14. How sweet would that be? 24.14 to 24.31 is 17 S&P points. You can make a heck of a nice amount of dough with a smaller amount of money on 17 as handle move, what we call in the business, on the futures. If you had bought the tactical lows as alerted. If you're chasing it over the 20, yeah, you could make money because the market could be very strong. There's half a day, it's all going to be machine driven, 110%. All right, so runs away and wants to hit this 24.43 level within the same half a day on Monday, it can happen. It can certainly happen. But by that point, you should be selling hard because this downtrend line is pretty vicious. Pretty vicious. You hit it every single time. Every single time. On the 19th of June, on the 20th of June, on the 26th of June, almost on the 28th of June, 29th of June. This is a powerful downtrend line. If this downtrend line is broken, we're making new highs. And this is where we are. This yellow line is your 5 SMA. That's your trader's friend, as I explained to everyone. It's kind of flattish to down. Nothing to write home about. This reversal candle stays intact. You're going to go higher and test the 24.40. Let's say it breaks above. Let's say it breaks above the 23.32. You got 9 points that you can make on the S&P 500. I believe that should be a good 60 to 70%, if not more, right? 60 to 70% if you're buying the money calls. You can't be buying all the way out because then the premiums will decay and you're not going to make money. You got to buy in the money. Buy a little bit. Now, here is something interesting I want to show you all. Real simple. See this major trading range? I'm going to take these two since this acceleration move. This is a big acceleration move, right? 2 Thursdays ago, on the 18th. Well, actually a month ago, a little bit more than a month ago, on the 18th of May. Look at the date down here. 18th of May. Big pivotal reversal. Let's use this as a reference point. You always have to use reference points when you draw technical charts. Let's cut out all the noise. Let's say we have no idea what the reason was, what the market did, what they did. Most of the times the markets don't even care about the news that's coming out. They just do what they want to do. So use this as a lower base at 23.43.42. Let's call it 23.44. And this is the upper end of the range, which is the pivotal breakout level that occurred on the 25th of May. We were there. We were there from around these levels. Powerful breakout, powerful, right? Powerful. So we made a powerful breakout from May 18th all the way up to the 2nd of June. And then now we're moving sideways in a tight range that I explained very clearly. Nothing really changed. Heavy volatility, sure. Intraday, multi-day, big fat candles, up, down, but within a range. This is a range. Right there is one range. That's what we're doing. We moved up and we're trading on a 70-point Dow range, holding the upwardly rising 34-day moving average, upwardly rising 50-day moving average. Beautiful. I drew some structured lines, as I always do, right there to show you. And let me show you a little magic, what might happen. All right, I've seen it happen a lot of the times. This range here, which I'm looking at, is roughly, well, let's call it 23.43, and breakout level here is 24.03. So 23.43 to 24.03 is what is it? 57, 60 points, right? 60 points. So this thing is 60 points, this range. I don't have my drawing tools here today for some reason, so I can't really draw and show you guys, but just focus, okay? It's not rocket science. It's kindergarten math. 60 points, this range. Add 60 to the 24.04 level. You arrive at 24.64. Let me show you some magic. I drew this uptrend line based on the contact points that I believe are valid. Guess where we can go? We go to 23.64. Whoa, magic, right? Go over this again. This range is 60 points. You add 60, well, a little bit more than 60 points. 60, let's call it 60 points. This trading range, right? This trading range that we broke out of. This one and this one. Forget this one for a minute. If I add this one, the market's going a lot higher. But just this one for now, because I took the pivotal reversal candle and we had multiple expansion candles over that multi-day rally that a lot of you just sat around and did nothing because you were too scared. That's okay. Fear is not a trading strategy. As I like to say, fear sucks. Anyway, I don't want to get into that behavioral game theory stuff right now. So bottom line is it's 60 points. Add 60 to the upper end of the breakout that occurred, and you arrive at the end of the rainbow, which is 24.64. How beautiful is that? I don't make up these numbers. This is not fake news. This is the facts of technical, tactical analysis. Right there. 60 points added to the breakout. I repeat again, you arrive right here at 24.64. Cool, huh? Can this happen? Sure can happen. Can happen in the month of July. Month of July. For the markets to go up from where we are right now in the futures, up roughly 6 points, 5.75. 24.26 to 24.60 is basically 34 S&P handles, E-mini handles, right? 34. Add 34 to 24, 26. I know some of you are hurting in math, but that's okay. Remedial math is not available in my service, by the way. You can check that with your 10th grader or your 7th grader. They'll teach you basic math, addition. All kidding aside, seriously, traders suck in math and percent.